time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Now I can get on to AirBoss of America Corp. I'll answer the question here. Symbol BOS on the TSX, trades at $7.13, $193 million market cap. What does AirBoss do? They develop, manufacture, and sell high-quality proprietary rubber-based products such as rubber compounds, rubber footwear, handwear, gas masks, anti-vibration, automotive components, and other industrial products, offering enhanced performance and productivity to the transportation, military, and industrial markets. The company also sold what is called PPE, or personal protective equipment, to the U.S. government during the pandemic and continues to sell that equipment. Essentially, this is specialized clothing or equipment worn by an employee for the protection against infectious materials. Now, there was a surge in sales and profitability during the pandemic. AirBoss was the beneficiary of pandemic-era non-competitive U.S. government contracts for its PPE equipment. The contracts are now likely somewhat one-time in nature, at least the metrics on those contracts are, and future contracts will be more competitive if signed, meaning they will not likely show the same profit margins during the pandemic when it was just a question of getting the product and there wasn't a question of what it cost, really. These contracts led to a massive spike in earnings. EPS in 2019, for example, was 55 cents per share. 2020, it was $1.49, so almost 3 times higher. Then in 2021, it was $1.54. But as the contracts kind of started to roll down, earnings cratered to a loss in 2022 of $1.26. So that is why you've seen the share price go from $46 down to $7. What did we see in Q1 of this year? Well, revenues decreased 19% to $117 million. Adjusted EBITDA was down 47.6% to 10.3. And EPS in the quarter was just 5 cents as opposed to 35 cents in the same quarter last year. Let's quickly look at the balance sheet. Cash of $16.6 million. Net debt here is about $122.35 million. So the trailing net debt to trailing 12-month EBITDA is in the range of 2.99, basically 3, as at March 2023. So this is okay, given it does have EBITDA. It is profitable, but not spectacular in a rising rate environment. And particularly the size of the company, these debt levels are a little high for our blood. Let's look at the valuations. Current PE based on 2023 expected EPS of about 23. Expected to see a jump in earnings in 2024. This is what the analysts are expecting. I think it might be overly optimistic if the macro environment continues to see some headwinds. So our take, it was somewhat encouraging to see AirBoss's profitability in the defense segment rebound in Q1 after 2 consecutive quarters of lackluster margins. The division reported adjusted EBITDA, which was positive 4.1 million compared to a loss of 1.5 million and 2.4 million in Q4 and Q3 of 2022. However, like I said, debt is high for a business of AirBoss's size and is cutting into profitability. With little revenue growth expected in 2023 and into 2024 at present, outside of new kind of unexpected contracts in its defense segment, the path to the higher share price appears to just be margin improvement. While this is a possibility, it could drive the share price higher. We like to pair profit growth with revenue growth, as in tandem, the two are a more sustainable path to driving consistent profit over the long term. And this will drive the share price not just to a rebound, but a sustainable uptick. At this point, we just monitor AirBoss as the growth does not match our criteria. Thank you.
Good job. I mean, there's a lot of businesses that had a big boom during the pandemic, but it was really just serving like a temporary market condition.
So many now that we're seeing, right? Like it's,
and in a lot of cases, once you get away from those year-over-year comparables, you start to just get back to the base core business. But
there may be an opportunity there at some point because some of them get really punished down. There may be an opportunity. In this case, I would still monitor. If there was a better balance sheet here, it might be intriguing. But at this point, that's not the case. So, I think there's better situations that could be beaten down, that got a one-time bump. We took advantage of that with a company called Biomed, which procured vents during the during the pandemic. Its share price got unjustly beaten down because they didn't have the same one-time sales in a couple of their quarters, and we're able to take advantage of it when it's pulled back. And since then it's up 130, 140%. Good core business, had a good balance sheet. That was the other thing that Viamed had, and that's why we've been able to profit from that over the last year.